at a high level, you have to think about what role government bonds play in your portfolio, that defensive aspect, and what you need that to do in particular environment.
Welcome to The Greener Way. I'm your host, Michelle Baltazar, Executive Director of Media at FS Sustainability. We are recording on Gadigal land and we pay our respects to the traditional custodians of country and elders past and present. In today's episode, we're going to discuss government bonds and their place in ethical portfolios. By the end of this podcast, we hope to provide some insights on what has fundamentally changed in recent years and where fund managers are likely to shift their allocation. Joining us to talk about this is John Woods, Deputy Chief Investment Officer and Head of Multi-Asset at Australian Ethical. John, thank you for joining us.
Great to be here. Thank you.
John, for those who are not familiar with Australian Ethical, can you please share us some basic stats about the fund? How many funds do you manage, the size of your investor base, or perhaps your assets under management?
Yeah, absolutely. So Australian Ethical is one of Australia's first ethical investment managers. We've been operating since 1986. I think at last count, we look after the retirement savings and investments of around 134,000 Australians and close to $15 billion of assets under management. We have a number of products from traditional superannuation products and risk profiles to funds that look after small cap Australian equities, Australian bonds, and private assets as well. So probably getting close to 15, 20 products on offer at the moment.
Wow. And 15 billion in assets under management as well. So it goes without saying then that with the sheer size of the fund's assets under management, that you're a significant investor in government bonds. So what are the additional considerations for you as an ethical fund manager when allocating to this asset?
What I've noticed is the expectations for how people invest ethically in equities have become really well established. But when you move to other asset classes like government bonds and credit and private markets, the expectations from investors isn't as clear. I think that was most pronounced a few years ago with on the eve of Russia's invasion of the Ukraine, we found a number of ethical investors actually held Russian bonds. And, I think they would have clearly flagged to people in sort of February 2022 that maybe they weren't the type of bonds that met with people's ethical expectations. So we have a sovereign bond framework. We focus on democracy and we focus on militarism. In a holistic sense, the role of government is important in society and we're supportive of that as an ethical investor. But we have these additional criteria around whether it's a well-functioning democracy, whether there's potentially some militaristic aspects of the government that we're not comfortable with.
Now, so you wrote in one of your investment columns, for example, that you've observed the changing perception around US Treasuries. So let's focus on US government bonds, that it's no longer the safe haven it once was. Why did you say that back then? I think this would have been a couple of years ago or so.
Maybe we start right up at the top level. What are the role of defensive assets in a multi-asset or a superannuation portfolio? They're there to preserve value in times of crisis and manage risks. Sometimes you're preserving value so you've got money to invest in those dips, those opportunities in equities markets, and sometimes to actually appreciate in value. What we noticed a few years ago is some of the potential scenarios for economic outcomes weren't supportive of bond prices, so they wouldn't be supportive of US Treasuries. And the reason that this was happening was because inflation was the biggest risk. And when inflation rises, it becomes difficult for a central bank to cut rates to support the economy. And if they can't cut rates to support the economy, that means they can't support bond prices when growth is slowing. So the time you need your defensive assets to be performing, the central bank is not able to play that role that it has from really the mid-1990s until 2021, 2022, and that undermines the credibility of this defensive asset class. Compounding that in recent times is the rise of populism. Willingness and capacity to pay is a key aspect of investing in debt. The borrower has to be willing and they have to have the capacity. So government debt has the capacity to pay. They can tax their citizenship to make sure they deliver on those coupon payments and repay that principal. But they've also got to be willing. And that with, the political environment that we've faced over the last few years, that willingness to pay has come into question. So it's become increasingly important to make sure that you're well diversified in that defensive part of your portfolio. US Treasuries are about 20% of the global bond aggregate index, which is a standard benchmark for global bonds, is a single issuer at 20% of that exposure. Is that really how much you want to have in a part of your portfolio that's meant to defend in difficult times? Or do you need to be more diversified?
So with that in mind, is it right to say that you've reduced your allocation, or how has that impacted your allocation into US Treasuries? And we haven't even discussed the fact that the US government has reversed a lot of its climate policies as well. So I don't know how that plays into your strategy as well.
What we have identified is it's important to have a range of defensive assets in the portfolio. Can't just rely on one or two. So what are other alternative ways to sort of protect your equity exposure? One is making sure you rely on the correlation between the Australian dollar and risk assets. Tends to be that when risk assets equities are falling, the Australian dollar is falling also. So if you've got foreign equity holdings, you preserve their value in that environment. That's been a really important lever. Investing in quality equities from the outstart is a really important lever in ensuring you've got a defensive portfolio. We find that actually plays quite well to ethical investors broadly. If you're investing ethically, you've almost got a double diligence process on your equities, thinking about how they're interacting with broader stakeholders and just financial returns. That tends to lift the quality of the portfolio. And then, of course, there's, we'll call it the dark arts, but things like optionality and derivatives and the role they can have in preserving portfolio value in times of crisis. Look, the US government's decision to step away from a number of their green-focused projects is really disappointing. At a high level, our focus is on whether it's a high-functioning democracy. And look, obviously the events recently challenged that. But at the moment, we're still exposed to US government debt. But we've been looking for other ways that we can have defensive exposure. Infrastructure debt, so supporting the transition domestically here in Australia has become a growing part of our portfolio. Our own local green bond market has really, particularly on a government level, has only really come into its own over the last year, and that's become a more important part of our overall asset allocation.
And now going back to your regular investment columns, you've been very good at sticking very close to a crystal ball, where in 2025 you said, well, AI is going to be a massive theme this year. And now we saw that even as far back as 2024. As we near the close of this calendar year, what were the investment themes that played out well? And what are those that suffered setbacks?
It has been a really interesting year so far in the way that investment markets have evolved. I wouldn't classify our investment insights as having a crystal ball, but we've got one central area of focus, which we sort of refer to as like deliberate diversification. Not only are we worried about the level of concentration in defensive portfolios, but we're worried about the level of concentration in equity portfolios like the Mag 7. You put the Mag 7 together with US government debt and you suddenly got 40% of your portfolio in one economy. So one of the investment themes that played out really well for us this year was actually taking a portion of our capital and seeking out areas like Europe and Asia as well, which didn't seem to have as much good news priced in to their equities. And that's come through really strongly. We've seen, some of the global leaders in AI are definitely in the US, but they're also in Asia as well. And we've also seen some of the green leaders are in Asia as well. So CATL, world's largest battery manufacturer, is located in Asia, and that's been a really successful investment as it came to IPO this year, underpinning our exposure to select Asian equities.
So put another way, the way that you would have invested a decade ago was very different to how we invest now, given the challenges of the US Treasuries being a safe haven, for example, but also the opportunities globally, like the Asian themes that you've just pointed out. John, you've been very gracious with your time and sharing your insights. Anything else you would like to share with our listeners on this topic of investing in government bonds?
Yeah, look, absolutely. I think at a high level, you have to think about what role government bonds play in your portfolio, that defensive aspect, and what you need that to do in particular environments. So if I think about the role of government bonds, particularly for an Australian investor, I want to make sure that I'm getting that CPI protection domestically. So maybe I've got a role for domestic bonds, domestic green bonds, a growing market, and what other aspects I can get from that exposure. What parts of the transition can I support? There's a lot more array of defensive assets available now than there was a decade ago, and I'd encourage investors to explore that broadly. Property, infrastructure, as well.
Well said. Once again, John, thanks for joining us.
Absolutely. Thank you.
This is The Greener Way. I'm Michelle Baltazar. Thank you for listening.
The Greener Way podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.